Going public. You know, it's the dream for so many startups, right? Ringing that opening bell, seeing your company's name on the ticker, it really looks like the ultimate launchpad to success. But what if it's not? For a lot of early-stage companies, especially up on Canada's venture exchanges, the reality is, well, it's a lot more complicated and a whole lot more expensive. Today, we're going to peel back the curtain and look at the real cost of going public.
Okay, so let's just dive right in. To give you an idea of the scale we're talking about, there are more than 2,250 companies listed on Canada's venture exchanges, like the TSXV and the CSC. I mean, it's one of the most active public markets on the planet for startups looking to raise some serious capital.
But, and this is a huge but, here's the catch. Out of all those thousands of companies, less than 5% of them are actually profitable. Think about that. The vast majority are just burning through cash, which means they're completely dependent on raising more and more money just to keep the lights on. And that's where the real cost starts to pile up.
So this brings us right to the heart of the matter. When one of these small public companies needs to raise cash just to survive, what does it truly cost them to get it? We're about to break down all of it, the fees, the fine print, and those hidden costs that aren't always so obvious.
All right, first up, let's talk about the price of admission. These are the straightforward, upfront costs that everyone sees when a company announces, hey, we've raised some money.
So the most common way these companies get their funding is through what's called a private placement. Basically, instead of selling shares to just anyone on the stock exchange, the company sells a big block of shares directly to a select group of investors, and they usually get it at a nice little discount to the market price. Let's walk through a quick hypothetical example. Say a company raises $1 million in a private placement. Awesome, but right off the top, you've got to pay the lawyers. Let's say that's 25 grand. Then you pay the brokers who found you the investors, and they typically take around 10%, so there goes another 100,000. So the company is left with $875,000. On the surface, that doesn't seem so bad, right?
But, as this quote from our source material points out, it's almost never that simple. You know, unless a company's management team is super experienced in the capital markets, the path to raising money often includes a ton of other expenses that never, ever get mentioned in that first press release.
And that brings us to the next chapter, the hidden financial drain. This is where a huge chunk of that investment capital can just quietly disappear before it ever gets a chance to actually help grow the business.
Okay, now let's look at this table again, but this time with the hidden reality factored in. A really common one is a big marketing budget, often required by the brokers. Let's add a pretty small one of $250,000. All of a sudden, that $875,000 we thought the company had, poof, it shrinks to just $625,000. The company now only gets to keep 62.5 cents of every single dollar it raised.
So why this massive marketing spend? You'd think it's to promote the company's products, but nope. It's usually designed to create hype and buying pressure for the stock after the financing is done. Why? So that the private placement investors who bought their shares at a discount can then turn around and sell them for a quick profit. The broker's main goal here is to generate fees and keep their clients happy so they can do it all over again with the next company.
And sometimes this whole thing gets even murkier with a little maneuver called a check swap. Here's how it works. The company writes a big check to a marketing firm, and then that same firm turns around and uses that exact money to buy shares in the private placement. So in reality, the cash never really enters the company's bank account to be used for the business. It's just a transaction on paper. The money does a U-turn.
The reason all of this revolves around a specific timeline is because of the mandatory 4-month hold period. See, investors in a private placement get their shares at a great discount, often 15 to 25% below the current market price, but the law says they can't sell them for 4 months. So that big marketing push we talked about, it's all designed to make sure there's a hot market for them to sell into the very moment that hold period is over.
Okay, so enough with the hypotheticals. Let's move on to a real-world example to see how this constant need for cash actually plays out. We're going to take a look at the financials for Chart Technologies, a clean tech company on the TSX Venture Exchange. Now this is a direct quote from their independent auditor's report in 2023. And let me tell you, a going concern warning is one of the most serious red flags an auditor can possibly raise. It is the formal, professional way of saying there is significant doubt that the company can even survive the next year without raising more money. And their balance sheet brilliantly illustrates why the auditors are worried. Look at that number at the bottom, the accumulated deficit. The easiest way to think of this is as the company's lifetime negative earnings. In just 1 year, it ballooned from negative $15.7 million to over negative $24 million. That is the result of massive continuous losses.
And their statement of loss tells the exact same story. In 2023, the company managed to bring in about $2 million in revenue. Pretty good, right? But its net loss for that same year was over $8.4 million. This gigantic gap between what they earn and what they spend is precisely why companies like this are stuck in a perpetual cycle of raising capital just to stay afloat.
So, knowing all this, how can investors in companies even begin to navigate this incredibly tricky environment? Let's switch gears and look at some advice for surviving and maybe even thriving in the venture market.
For investors, it's all about doing your homework and asking the tough questions before you even think about jumping into a private placement. Who else is investing? Is there a strong lead investor? That's a great sign. How much are the brokers getting paid? Is it excessive? And maybe most importantly, you have to ask, is there a big marketing program or a check swap involved? This helps you figure out if the money is actually going to grow the business or if it's just there to give other investors a quick exit.
And for the companies themselves, the big piece of advice is to focus on the quality of the capital, not just the quantity. Instead of a deal with dozens of small investors who are just going to flip their shares in 4 months, try to find a single strategic partner like a family office or a bigger corporation, someone who actually believes in your long-term vision. Offer them the discount directly and build a real partnership that helps you avoid this whole damaging cycle.
Which leaves us with one last big question. For an early-stage company that's desperate for cash, the public market seems to offer a lifeline. But as we've seen, that lifeline can come with so many strings attached that it risks becoming a trap, a never-ending game of raising money just to pay for the cost of raising money. So is going public really a launchpad, or is it something else entirely?